For nearly a century, Merrill Lynch stood as one of Wall Street's most recognizable names, earning the nickname the Thundering Herd for its aggressive growth and massive network of financial advisors. Founded in 1914 by Charles Merrill and Edmund Lynch, the firm revolutionized investing by bringing Wall Street to Main Street, democratizing access to financial markets for ordinary Americans. But in September 2008, this legendary institution found itself on the brink of collapse, its fate sealed by catastrophic bets on collateralized debt obligations that would force the most desperate weekend sale in Wall Street history. The story of Merrill Lynch's rise and fall is a tale of innovation, hubris, and the ultimate price of excessive risk-taking in the derivatives market. Charles Edward Merrill was just 29 years old when he opened his brokerage firm in 1914 with partner Edmund Lynch, starting with initial capital of only $5,000. Merrill had a revolutionary vision. He wanted to make investing accessible to middle-class Americans, not just the wealthy elite who traditionally dominated Wall Street. The firm's early motto was, "Investigate, then invest," emphasizing research-based decision-making over speculation. By 1916, Merrill Lynch was already making waves by taking Kresge, the predecessor to Kmart, public in one of the largest retail offerings of its time. The firm's innovative approach included publishing detailed research reports and encouraging small investors to diversify their holdings, practices that were virtually unheard of in an era when stock tips and insider information ruled the market. When the 1929 stock market crash devastated Wall Street, Merrill had already advised clients to reduce their stock positions, having sensed trouble ahead, which enhanced the firm's reputation for putting client interests first. The post-World War II era marked Merrill Lynch's transformation into a financial powerhouse. In 1940, Charles Merrill made the bold decision to merge with E.A. Pierce & Company, creating the largest brokerage firm in the world at the time, with over 90 offices nationwide. The firm pioneered the concept of comprehensive financial planning, offering everything from stock trading to investment advice under one roof. By 1956, Merrill Lynch had introduced the first cash management account, revolutionizing how investors could access their funds. The company's marketing genius was evident in its 1973 adoption of the Thundering Herd slogan, accompanied by the iconic bull imagery that became synonymous with market optimism. During the 1970s and 1980s, Merrill Lynch expanded aggressively into investment banking, competing directly with white shoe firms like Goldman Sachs and Morgan Stanley. The firm went public in 1971, raising capital that funded its global expansion, and by 1985, it had established significant operations in London, Tokyo, and other major financial centers worldwide. The 1990s represented Merrill Lynch's golden age, as the firm capitalized on the technology boom and the longest bull market in American history. Under CEO David Komansky, the firm's assets under management soared from $300 billion in 1995 to over $1 trillion by 2000. Merrill Lynch's wealth management division became the envy of Wall Street, managing money for over 5 million individual investors through a network of more than 14,000 financial advisors. The firm's investment banking division was equally impressive, consistently ranking among the top 3 underwriters of corporate bonds and equity offerings throughout the decade. Research was another crown jewel, with Merrill Lynch analysts like Henry Blodgett becoming household names during the dot-com boom, even as their overly optimistic recommendations would later draw regulatory scrutiny. The firm's proprietary trading operations generated massive profits, contributing significantly to record annual earnings that peaked at over $4 billion in 2006. However, beneath this success lurked the seeds of destruction, an addiction to mortgage-related derivatives that would ultimately prove fatal. Beginning in the early 2000s, Merrill Lynch dramatically expanded its exposure to collateralized debt obligations, complex securities backed by pools of mortgages and other loans. The firm's fixed income division, led by executives hungry for the enormous fees these instruments generated, began creating increasingly exotic CDO structures. By 2006, Merrill Lynch had become one of the largest CDO underwriters on Wall Street, packaging over $44 billion worth of these securities in that year alone. The firm wasn't just selling these instruments to clients, it was keeping massive quantities on its own books, betting that the housing market would continue its seemingly endless ascent. When other firms began reducing their mortgage exposure in late 2006, Merrill Lynch doubled down, accumulating what would eventually become a $30 billion position in CDOs and related mortgage securities. The beginning of the end came in 2007, when the subprime mortgage crisis began to unfold. Stan O'Neill, who had replaced Kamansky as CEO in 2003, initially dismissed concerns about the firm's mortgage exposure, telling investors that Merrill Lynch was well positioned to weather any downturn. But as housing prices began to decline and mortgage defaults soared, the value of Merrill's CDO portfolio started collapsing at an alarming rate. The firm reported its first quarterly loss in 6 years in the third quarter of 2007, a staggering $8 billion hit that shocked Wall Street. O'Neill's attempts to explore a merger with Wachovia without board approval led to his ouster in October 2007, but the damage was already done. His successor, John Thain, the former NYSE CEO, inherited a company sitting on a ticking time bomb of toxic assets that continued losing value by the billions each month. Throughout 2008, Merrill Lynch's situation deteriorated rapidly as the credit crisis deepened. The firm raised capital desperately, selling preferred shares to sovereign wealth funds and other investors at increasingly unfavorable terms. In January 2008, Merrill announced another massive write-down, this time $14 billion, bringing total mortgage-related losses to over $20 billion in just 6 months. Thain attempted to stabilize the firm by selling assets and cutting costs, but the CDO portfolio continued bleeding money as the housing market showed no signs of recovery. The firm's stock price, which had peaked at over $97 per share in early 2007, fell below $20 by September 2008. Rating agencies began threatening downgrades that would have triggered billions in additional collateral requirements, potentially forcing the firm into bankruptcy within days. The weekend of September 13th and 14th, 2008, became the most crucial 48 hours in Merrill Lynch's nearly century-long history. As Lehman Brothers teetered on the edge of collapse, Thain realized that Merrill Lynch could be next, especially given the firm's similar exposure to mortgage-related assets. With the Federal Reserve refusing to provide the same support it had given Bear Stearns earlier that year, Thain knew he had to act quickly. Bank of America CEO Ken Lewis had been interested in acquiring Merrill Lynch for months, seeing the firm's massive retail brokerage network as the perfect complement to his bank's deposit base. Negotiations began Friday evening and continued through the weekend, with both sides knowing that failure to reach a deal could result in Merrill's collapse when markets opened Monday morning. The final agreement, reached Sunday morning just hours before Lehman announced its bankruptcy filing, valued Merrill Lynch at $50 billion, or $29 per share. The sale to Bank of America officially closed on January 1, 2009, ending Merrill Lynch's 94 years as an independent firm. The integration proved challenging as cultural differences between the traditional commercial bank and the aggressive investment bank created tensions that persisted for years. Thain's decision to spend over $1 million renovating his office while the firm was collapsing, including an $87,000 area rug and a $35,000 toilet, became a symbol of Wall Street excess and led to his dismissal within weeks of the merger's completion. The final tally of Merrill's mortgage-related losses exceeded $55 billion, making it one of the largest financial disasters in corporate history. Bank of America itself nearly collapsed under the weight of Merrill's toxic assets, requiring a second government bailout and years of legal settlements totaling tens of billions of dollars. Today, while the Merrill Lynch name survives as Bank of America, Merrill Lynch, the independent firm that once democratized investing and earned the loyalty of millions of Americans, exists only in memory. The collapse of Merrill Lynch stands as one of the most tragic stories of the financial crisis, illustrating how even the most established and respected institutions could fall victim to excessive risk-taking and poor judgment. The firm that had survived the Great Depression, 2 world wars, and numerous market crashes was ultimately undone by its own greed and mismanagement of derivatives it barely understood. The speed of the firm's demise was breathtaking, from record profits in 2006 to a desperate weekend sale less than 2 years later, proving that in modern finance, reputation and history mean nothing when balance sheets are overloaded with toxic assets. The thousands of Merrill Lynch employees who lost their jobs, the shareholders who saw their investments evaporate, And the clients who trusted the thundering herd all paid the price for decisions made by a small group of executives who prioritized short-term profits over long-term survival. Perhaps most tragically, the firm's collapse marked the end of an era when major Wall Street firms were partnerships where senior executives had their own money at risk, replaced by a corporate structure where CEOs could walk away with golden parachutes while their companies burned to the ground.